talk about gold, basically what factors affect the price of gold and why I think, therefore, gold is going to do well next year. You know, last year, as we know, we saw high inflation, rising inflation. We had a war in Europe. And we also had stocks and other assets that were, for most of the year, down, and certainly volatile on the downside. That, to many people, was a perfect trifecta for gold. And yet gold, as we know, was down for most of the year, disappointing many gold investors and frustrating many gold investors. So why did gold not do well last year? I think there are some misconceptions about what drives gold. Let me start by saying and emphasizing that inflation in and of itself does not move gold. In fact, the correlation between gold and inflation, if you look over time, is actually quite weak. One reason for that is that when inflation is going up, investors fear that central banks will hike rates, which, other things being equal, is bad for gold. The markets are always forward-looking. So gold may go up in nominal terms during an inflation, but in fact, in real terms, and particularly compared with other assets, it is not a very good inflation hedge. This is a picture of gold and the CPI. For this period of time, in the 70s, the correlation is very strong. If you look at gold and inflation from 2008 to 2012, it's a lot less strong. If you go back in history, gold, in fact, has not performed well in inflationary periods, long inflationary periods. It's performed much better in deflationary periods. There was a path-breaking book by Professor Roy Jastram called The Golden Constant. I'm sure some of you will know it. And he looks at prices of gold and consumer prices year by year, all the way back to the early 13th century. And if you look at that, you find that gold's best performance in real terms and relative to other assets has actually been in deflations. So that's the first thing. The second thing is as wars and geopolitical events. You know, there was a war in Ukraine, and people were saying, well, with a war between Russia and Ukraine on European soil, gold should be soaring. And again, that's a misconception. Gold, typically, the effect of geopolitical events on gold tends to be very short-lived. And in fact, gold, being a forward-looking asset, typically moves up strongly during what we might call the gathering storm, and when the event actually happens is often the peak for price, the peak price for gold. So we can look here. This is difficult for you to see. I don't expect people to look at all of this, but this is from 2001 onwards, and there are various geopolitical events. If you look from 2001 to 2012, gold was already in a bull market. So, but these geopolitical events had very, very short-lived, even 9/11 had very short effects on the price of gold. If you go back to the 70s, really the same thing holds in the 70s and 80s. The only time that the geopolitical event had a significant effect on the price of gold was the Iran hostage situation. But again, gold was already moving up strongly during that period. And that's the point I would say. Geopolitical events in and of themselves tend to have very short-lived effects, and they only have effects when gold is moving up anyway. So we saw this with, Ukraine. Yes, there was an effect for a week, and then the gold price just drifted down, even though the Ukraine situation is by no means over. The third thing I mentioned was other asset prices, stocks and other asset prices going down. People thought, well, this should be good for gold. But in fact, again, it's a very, the correlation, let's say, is not very strong. There are times when gold does well, when stocks go down, and there are times when gold doesn't do well, when stocks go down. That's a whole different conversation. I'd be happy to talk to people individually about that, but let's just say for now, but neither inflation in and of itself, nor geopolitical events, nor weak stocks is really what drives gold on a longer term basis. And of course, we know that there were two main reasons that gold did not do well last year. One, of course, was the higher dollar. Other things being equal, the dollar going up is bad for gold. And then the other thing, of course, was the asset deflation caused by global central bank tightening, rising interest rates and withdrawing liquidity. And so around the world, all assets, including gold, declined. But as you saw in the preview, gold actually did very, very well in terms of most currencies. Other than the US dollar, the Brazilian real, and the Mexican peso, which is not on that graph, gold was up in terms of most currencies. For you here in Canada, it was up almost 7%. So nothing wrong with that at all. So currencies, the currency movement is clearly a main determinant for whether gold has done well for you or badly for you. In dollar terms, US dollar terms, gold ended the year flat, which again, I think was very strong performance, given that the dollar was up over 8%. The dollar's up 8%, other things being equal, you'd expect gold in dollar terms to be down 8%. And that's 8% after the sharp slide in the dollar at the end of the year. So I think we can say that gold actually, it's a misconception to say gold didn't do well last year, and people should not have been disappointed with gold's performance last year. Even in dollar terms, which of the major currencies was the worst gold performed worst of the major currencies for dollar holders, it still held its own. Which is reasonably strong. So what are the main factors that do affect gold? I already mentioned that obviously the dollar is one main factor. Gold has a very, very strong, and this is to be expected, gold has a very strong inverse relationship with the price of gold. And you can see it on this chart. As for interest rates is another important factor, but interest rates is a little more complicated, just a little, than the very, very clear and direct relationship between gold and the dollar. So gold and interest rates is a little more, it's less straightforward than gold and the dollar. Sometimes when rates are going up, gold falls sharply. Sometimes when rates are moving up, as you can see here, this goes back to 1993. Gold actually continues to move up, even though interest rates are moving up. And this is gold and interest rates. I've zoomed in a little bit so you can see it a little bit more clearly. Again, sometimes rates are moving up, 2005, 2006, 2007, and gold is moving up. That's not the popular conception. The popular conception is when interest rates are moving up, that's clearly bad for gold. Not necessarily so. The key, obviously, everybody knows it's not just interest rates, it's real interest rates, right? Are interest rates moving up in real terms? But it's even one step beyond that. It's does the market think that central banks will continue to hike rates and beat inflation? That is the real key. And you saw this very, very clearly in the 1970s with Arthur Burns, poor old Arthur Burns, who everybody says is such a weak, well, he was, but such a weak Fed chairman. But people tend to forget that Arthur Burns, when he was Fed chairman, was increasing interest rates quarter after quarter after quarter, under Arthur Burns, interest rates were moving up. So why was gold continuing to move up, even though Arthur Burns consistently, you can see this from 77, was raising rates? It's because rates were either lagging inflation or were more or less in line with inflation, but they were not ahead of inflation. And the market did not believe that Arthur Burns had the fortitude to do the job. And they were right. When Volker came in, you can see that interest rates were already high when Volker came in, and inflation was certainly high. But what Volker did was Volker pushed rates above the rate of inflation. That is the critical key. He raised rates sharply above the rate of inflation, and the market believed correctly that he would finish a job, right? So where are we now? We have a Fed that has raised rates. On a percentage basis, they've raised rates faster than any time in history. Basically going from 0 to 4.25% and probably 4.5% next week in less than a year is a very, very dramatic change in interest rates. 6 months ago, a year ago, I think it's true to say that the market believed Jerome Powell when he said, we're going to stay with this until the job is done. So where are we now? Well, now, even with the rate of inflation coming down, and even with interest rates going up, interest rates are still lagging inflation, and lagging by a fairly consistent level. The market is beginning to think that perhaps the Fed under Powell will not finish a job. And I was never one of those people that thought the Fed would not raise rates, that the Fed would pivot immediately there was a sign of trouble or anything. But already the Fed is beginning subtly to change its tune. Powell has changed from saying we're not going to stop until inflation is at 2%. His last press conference in December, when he was asked the question, what will make you cut rates? He foolishly answered that. He shouldn't have answered that. He should have said, we're going to keep on with the job until the job's done. He said, when we're confident that inflation is heading towards 2%, we might cut rates. Completely different from saying, we're going to keep until rates are 2%. And there's been other sort of straws in the wind. So the market is now beginning to realize that the Fed is definitely slowing, obviously, but they're probably going to pause pretty soon, and we're probably going to have a situation that even if the nominal rate of inflation, the headline rate of inflation, comes down a little bit more, they will not have killed inflation. Inflation is a very resilient beast. We saw that in the 70s. You can depress inflation, but if you don't kill it, it bounces back pretty quickly. And that's the situation we're in now. We're also heading for a recession, certainly in the US. And there's been a lot of talk recently, especially after the latest GDP number came out. People are saying, the GDP number was positive, it was better than people feared. That sort of puts a lie to the recession is imminent talk. And I would say baloney. Milton Friedman showed us 40 years ago, and Jerome Powell even referred to that at his last press conference in December. Monetary policy works up and down. It works with long and variable lags. So it has very short-term effects on interest rate-sensitive sectors like housing and automobiles. And we've seen that in the US, we've seen that in Canada. Housing in the US, housing starts have collapsed, housing permits have collapsed, housing sales have collapsed. Any interest rate sensitive sector is affected by changes in interest rates very, very quickly, up or down. But other sectors, the lags can be quite long, and the lags in monetary policy are often a year to 18 months. We only started on this track, in April last year. That's not even a year yet. People point to retail sales. Retail sales are strong, they say. That means the consumer is healthy. Certainly the administration has said that, and the Federal Reserve has pointed to that, and many economists have pointed to that. Well, the consumer's healthy because retail sales are holding up. But retail sales since April are basically flat. So if prices have gone up 7 or 8%, and the dollar volume, the dollar of retail sales is flat, that means people are buying less, right? People are buying less, or either buying less quantity, or they're going from higher quality goods to lower quality goods, and the latter is what we're seeing a lot of recently. But at the same time, savings in the US have collapsed, the savings rate has collapsed, and most of the buildup in savings that we saw in 2020 from the lockdown, we saw that around the world, when people were locked in, they weren't spending so much, so savings went up. Most of the savings that were built up in 2020 has evaporated already, and more significantly, credit card debt has ballooned to 20-year highs, and now we're beginning to see credit card defaults. So this is a totally logical pattern. Prices are going up, but you want to continue buying cornflakes for your kids, and you need to continue to go to work and buy gasoline. So initially, you continue to spend. You have to. And you spend by drawing on your savings initially, and then when the savings are gone, you start using the credit card and not paying it off. This is a perfectly logical progression. But then at some point, after you started using the credit cards too much, credit card defaults start increasing. And several credit card companies in the last month, in fact, have warned about increasing credit card write-offs and defaults. Discover, Chase, several of them have. And what comes next? Well, after you've used all your savings, and after you've run up a credit card debt and can't afford to pay it off, what comes next? You have to spend less. You have no choice but to spend less. So retail sales are about to roll over in my mind. And we could go through sector after sector and show that these lags of the interest rate hikes that we've already seen are only now beginning to have the impact. So what we're looking for, the outlook, is for a sluggish economy at best, a recession more probably, at the same time as we have inflation. That's stagflation. The best performing assets in a stagflationary period are gold stock, which is not here, commodity stocks. This is emerging markets, but it's really smaller market bonds, smaller market stocks, and the worst performing assets are developed market stocks, developed market bonds. So my conclusion, for many, many reasons, history and theory, would be this is a wonderful time to be looking at gold. I think it's vulnerable in the next week or so as the Fed talks, but beyond that, this year is going to be a remarkably powerful year for gold, in my view. Thank you very much.